Hi everyone, and welcome to our Friday show. My name is Jayna Rana and I'm an investment company analyst here at QuotedData. As always, we'll be kicking off today with a roundup of this week's biggest investment trust stories. And as we're at the start of the month, we will also be joined by Andrew McHattie, who will run you through the significant price and discount moves in the sector over August. Finally, I'll be speaking to our special guest, Tim Levine, CEO of Augmentum FinTech. If you have any questions for him or for any other topics mentioned during the show, you can use the Q&A box at the bottom of the screen. So this week, which as you know with the Monday bank holiday, was a short week and a pretty quiet one at that. But I'll be talking to you about a fundraise proposal at SDCL Energy Efficiency Income and a development in the Trian Investors One saga. So first up, we have SDCL Energy Efficiency Income, which has announced a proposed placing to raise around 100 million through an issue of new ordinary shares at a price it expects to be between 113 pence to 117 pence per new ordinary share. In addition to the placing, the company plans to open the opportunity to its existing retail shareholders in the UK via Rex, the technology platform owned by Peel Hunt. AJ Bell, Hargreaves Lansdown and Interactive Investor have already confirmed that they'll be participating in the offer. So before I go into the whys, I just thought I'd share a little bit about the trust for those who may not be familiar with it. I'm sure you can already tell from its name, SDCL Energy Efficiency Income. The portfolio focuses on clean energy, but also energy efficiency project finance. So it launched at the end of 2018 and is part of the renewable energy infrastructure sector. I know we usually look at 12-month performance here, but I thought it'd be interesting to show you how the trust has fared since its launch. So as you can see, it was massively hit by COVID in early 2020, as with many other funds and sectors and markets. But it bounced right back up and has been steadily increasing ever since. And though there has been some volatility since the start of this year, numbers have still been high, which I think has a lot to do with this increasing awareness and the need for renewable sources of energy, especially in light of what's happening with Russia. And looking at the discount, or rather the premium, as it's only ever traded on a discount during that COVID hit already mentioned, the trust today is on an 8% premium, but that has quite often been in the double digits, as you can see here, which I think leads nicely onto the explanation behind this fundraise. So the trust has performed well and been pretty active since its short life, during its short life so far. It's due to complete on its acquisition of United Utilities Renewable Energy soon, which was around 100 million. And it also has about 80 million worth of commitments to 8 different organic flow-on opportunities, which are expected to take place over the next 12 months. This means that the company will have committed all of its available cash and substantially committed its revolving credit facility, which was worth about 145 million. So it needs the fundraise because it's still seeing plenty of investment opportunities. This includes what it calls organic opportunities, which are further or follow-on investments in projects or frameworks already in the portfolio. But there's also a much broader pipeline of new opportunities totaling over £400 million. So just a final point on this, the offer is expected to close at 3 p.m. on the 6th of September, that's next Tuesday. Shareholders should also note that the intermediaries, which I mentioned earlier, may have earlier closing times. So our next story is a development, or rather a final resolution to the Trian Investors One saga. For those unfamiliar with the trust, it's a bit of a unique structure in that it aims to generate capital appreciation through the investment activity of Trian Investment Management and its parent company, Trian Fund Management. So what was announced today? In a nutshell, it's agreed to compulsorily return investor capital and wind up the trust. So this comes after an EGM meeting, which was called at the start of August, which saw shareholders oust the previous chairman, which I'll explain a bit more about shortly. But as a result of that meeting, the board has agreed to redeem no less than 95% of each shareholder's investment in the company by no later than 30th of June next year. Following the redemption, the company will be wound up with any remaining asset value to be returned to investors. Meanwhile, Trian will also receive its final management fee through to 31st of December 2023. So just a bit of background on the EGM, which was held on the 5th of August 2022. It was called by an ad hoc of independent investors, including names like Janice Henderson, Invesco, among others. So they wanted to replace 3 of the trust directors for not meeting the required standards of corporate governance, and also proposed 2 people to replace them. They argued that this would create a new board with the majority of independent directors, which would mean an acceptable standard of governance, but also to restore the trust and confidence of the shareholders. Following that meeting, the chairman, Chris Sherwell, was removed from the board and a restructure took place. So just going back to today's news, the board has said that these proposals are a positive and sensible way forward, and shareholders totaling 86.3% of issued share capital did support these proposals. We also think that it's good to see some form of resolution being put forward, even though it's not great that shareholders had to force hands in this way. However, we do think that the portfolio, which is basically Unilever and Ferguson, which I'm sure you're all aware are large and liquid companies, they're easily accessible directly. So we're not sure what value the manager would be adding at this point in order to justify a management fee to the end of next year, as well as performance incentives. You can read more about our thoughts on the news story that was posted this morning on our website, but the bottom line is that we feel that given investors' disappointment here, the manager should be returning cash to shareholders today and drawing a line under its fees at this point. So next I will be passing the reins over to Andrew McHattie, who will run you through the significant price and discount moves in the sector over August.
Lovely. Thank you very much indeed, Jayna. A very good morning to everybody. I'll just switch over to my screen and yeah, we'll have a talk about what happened in August, which was a reasonably quiet month overall for the sector in terms of the aggregate movements. There wasn't much shift in the sector index, but there was a lot of movement within that, as always. So I'll talk about the movers. There are some old favourites at the top of the list of risers here. Schiehallion Fund, which tends to be either on the risers or the fallers, actually recently is at the top again. And in second spot there is Geiger Counter, which has had a particular boost this month from the news that Japan is having a rethink about its nuclear power policy and may in fact consider some new facilities there. That's quite a big U-turn and augurs well for the future demand for uranium, which is why Geiger Counter has gone up. And yesterday you may have heard on the news that Boris Johnson was promoting £700 million of investment into Sizewell B in Suffolk as well. So the only thing I would say is that there's an awfully long lead time on these new nuclear power station builds. So you know, don't expect uranium demand to go up in a rush there. Power was a big feature here. Clearly, energy is at the forefront of most of our minds. And in addition to Geiger Counter, there's Gulf Investment Fund on the list of risers here, BlackRock Energy and Resources Income, and Next Energy Solar. The BlackRock Trust is interesting because that does have roughly half of its assets devoted to energy. And I think it's just worth pointing out that actually BlackRock World Mining doesn't have that energy exposure. That's really more about metals. But because we've talked about energy so much, today I'll just pick something else out and have a quick word about Biotech Growth Trust from that list. On the way down, there were some equally large moves here. Now, there are a couple of growth trusts at the top, which are still being troubled by the duration argument, I think, which is hammering growth stocks. And it'll be interesting to see what Tim says about that. It's quite difficult with timing here. You know, that there's clearly a lot of value on offer because operationally, a lot of the underlying investments are still doing very well. But if you had bought into these at any time really over the past 3 months, you'd be looking a bit sad now in terms of the value you've lost. There are special factors at play here. Chrysalis Investments is still very much under the cosh because of its enormous performance fee paid to the managers when they did well from Klarna, which is now busily pumping out bad news on a regular basis. And Seraphim Space, which had a good month in July, gave back those gains because it announced that it's holding in D-Orbit, which it had hoped would combine with a SPAC, a special purpose acquisition company. That deal is not going through any longer, which is not really a surprise, but it's a disappointment because there was scope there for a very large uplift in value, which could have been tenfold on the holding. But outside of those growth stocks, I think the theme here is partly that there's a lot of real estate on the list. And I'll talk about a couple of those today, Tritax Big Box REIT and Civitas Social Housing. So first of all, on healthcare, which I think anyone who's fairly long in the tooth and has been in the market for a while will always think of as a defensive sector for fairly obvious reasons, really, that healthcare is such an important expense in people's lives. It's not a discretionary thing like your Netflix subscription or perhaps in this winter, how long you're going to leave your heating on for. It's such an important thing that actually the demand is fairly inelastic, and therefore it can fare well in more difficult economic periods. But I do think over recent times, actually, biotechnology in particular, as a subsector of healthcare, has been lumped together with technology and has suffered because of the duration argument. And therefore, it's been quite a difficult period actually for this sector, not helped, of course, by the continuing narrative about drug pricing and whether the US politicians are going to really clamp down on this. That's just an ongoing theme that I've been listening to for years, actually, from everyone in the sector. And it's always proved to be a red herring because politicians talk a good game there and actually end up doing virtually nothing. So I think there are reasons to think healthcare might do a bit better. And it's quite interesting now, I think maybe the cycle's turning a little bit and investors are starting to remember that actually it's a defensive sector. These are figures from the US where the healthcare industry is really based. In the blue, you have the performance of the healthcare sector over the last 3 and a bit years here. And you can see that it's underperformed the broader sector in the red, the broader market, quite consistently throughout 2019, 20 and 21. And this year it has outperformed, but only just because it's gone down a bit less, but it has still gone down. But I've been reading some interesting data on just how well, in fact, healthcare earnings have tended to hold up during recessionary periods. There's a bit of data here from Reuters showing that during the great financial crisis, broad S&P 500 earnings fell for 9 straight quarters, but healthcare earnings actually rose over that period. And over the last 25 years, earnings from the sector have been significantly better than the average. So there are reasons to be a bit optimistic. And if we look at the performance of this is a very busy chart here showing you all of the sectors in the S&P in the year to date. The outlier here is energy for obvious reasons. And then after that, we have most of the old favorites that have done slightly better than average, which are consumer staples, utilities, and then healthcare. But actually, again, from the reading I've done, it seems that these other sectors, the consumer staples, utilities, and energy, are all quite expensive now, whereas that's not true of healthcare, which is still trading on a below average rating if you look across the broad US market. So on that basis, there's some interesting value that could be available here. And I think if you're looking at the sector, the Biotech Growth Trust, which you can see here has definitely been moving up over the last couple of months. That's probably the punchy option in the sector. It went down more in the downswing, and now it's proving to be the best performer on the way up. It's on a reasonable discount of 7.8%. but I think you would have to be looking for some significant volatility if that's the one you're going for. There are actually quite a few good options, I think, in the healthcare sector at the moment. Things like Bellevue Healthcare, RTW, again at the punchy end, Worldwide Healthcare Trust. There's quite a few actually that look decent value. I think as well, if you're looking at more on the fringes of the sector, perhaps at real estate that's linked to healthcare, there's very good value on offer here now, I think, from Impact Healthcare and Civitas Social Housing. Now, the social housing has been a pretty difficult sector for a while now, and is periodically subject to some negative publicity, and we've definitely seen some more over the last month, and that has depressed the price. But actually, again, if you look at the operational performance of Civitas and Triple Point Social Housing, they've really been quite good. And my feeling is that you're being quite well compensated for the risk at this level. So the yield on Civitas Social Housing is now over 8%, which is very attractive, as long as you feel that's going to be maintained. And the discount to NAV there is 39%. So there's clearly some operational risk here, and I think you need to be willing to bear that if you're going to buy it. But I think with that kind of yield and discount, you're being very well compensated for it. And generally, the real estate sector now is offering all sorts of grand opportunities that didn't exist a few weeks ago. Here's a tremendous example that really it shocked me actually when I looked at all of the data on Tritax Big Box REIT. When I knew that logistics had fallen out of favor really since Amazon said that it was scaling back its demand. But the swing here has been huge, because Tritax Big Box was really the darling of the sector, and just back in April, so not that long ago, just a few months, it was on a 27% premium to NAV at that point. It's now fallen away, and actually fallen a little bit more since I made this slide yesterday. And it's now on a 34% discount, which is enormous. That's a very, very big swing. You don't often see swings of that size. And maybe that's a little bit to do with the summer and the fact that trading volumes are a bit lower. And there's a reason for this, because logistics was very much at the low yield end of the real estate market. And I think that's where, again, if you're looking at the duration argument, that's where demand is going to slacken. But actually, the trust itself has not reported any fall in NAV or any reduction in yield. And if you read the manager's latest statement, they're still quite confident. So there's a decision, I think, here for investors to make. And if you look at the way the discounts moved here over the last year, you can see this really very sharp sell-off. So I think the first question of probably three you need to address if you're thinking about buying this is whether the valuation pendulum has just swung too far now. And this chart here actually shows the premium or the discount since the trust's inception in 2014. And you can see it has traded on a premium for most of its life, fell to a discount during the pandemic, and then again now. And this has now extended to 30% plus. And I think we're seeing discounts now of a size we've never seen before in this trust. And whilst you can always be proved very quickly wrong by making predictions on this, it does look as though this is an extreme position. So the second thing here is to consider what the risk is and whether, in fact, that extreme position might be corrected by the share price coming down rather than going up, or the NAV coming down, sorry, rather than the share price going up. And I think the risk here is really from construction as far as this trust is concerned. I mean, it has taken on additional risk by deciding to build its own warehousing, but it's already pre-let more than half of its new space, and we'll have to see how that plays out. And I think the third thing to consider here is, just what new factors might well emerge as part of the inflationary environment we're in. And you would imagine that in this tougher environment, actually, consumers are going to become much more price aware and price sensitive. And that makes it less likely, probably, that they're going to go to physical shops and make impulse purchases. They're probably going to be even more focused now on shopping around for the best price, comparing prices. And of course, the best place to do that by far is online. And so you can imagine actually online shopping may get some fresh impetus from this inflationary environment where we're all becoming much more price aware. And if you look through the list of the largest clients of Tritax Big Box REIT, there's a lot of food here. And there's a lot of, these are big companies with, Tesco, Ocado, M&S, where you would think actually the demand might be quite resilient. And so I feel that there's quite a good chance here, actually, that the pendulum has swung too far against big box. And clearly it's a matter of sentiment, and that may take a while to change. But if you're buying in now, you're getting roughly a 4% yield on the shares, which is certainly better than it has been. And I think you could afford perhaps to buy in now and sit tight and see how it plays out. I was just looking at the questions, and I think there's a question just about urban logistics REIT and whether that might be better value as a more of a last mile logistics play. Potentially, yes, and big box, I think, is more likely to suffer. That's been the market view. But if you look at the swing in valuation that's occurred on urban logistics against Tritax, there's no comparison. There has been a bit of a derating on Shed urban logistics, but nothing like the derating on this one. And so my view is that the real opportunity is in this one at the present time in share price terms, although you may find that operationally urban logistics has a bit of an edge. There's also a question about private equity on chunky discounts. That's very true, and Tim can maybe say a bit more about that. It has been, but my feeling, and the next slide talks to this, is that actually the real estate sector has emerged over the summer as the place where there is the richest opportunity set at the moment. I've seen considerably more in the way of suddenly depressed share prices in this sector. So this is where the summer shakeout has really occurred, in my view, and the big valuation swing. On this chart here, which is from JP Morgan Cazenove, which is a sector chart that goes back to 2017, so it's a 5-year chart. You can see that the NAV in the sector has progressed actually pretty steadily over that time. It's the green line here that's really the interesting one, which is the average discount in this is the UK commercial sector, so it's the more generalist property trusts. But you can see that the valuations have really slipped off quite a bit of late. And you can see this from the yields as well available in the sector. Again, on the generalist trusts, the many yields are now over 5%. The average is now 5.5%. And I look back because my sense was this had changed quite a lot in the last couple of months. So I just checked the figure for the beginning of July, and it was 4.2% at that point. So you're getting a lot of extra yield now from this sector. And my sense is that, again, clearly timing is the most difficult aspect of this, but certainly a lot of the bad news, I think, has to be in the price now, because the discounts have really widened out so much. And it was quite interesting listening to Jason Bagley the other day of Aberdeen Property Income, who was really quite excited by what's going on in the market and the fact that there are these dislocations occurring and there's a bit of repricing and some people are pulling out of deals. And for him, that meant that, again, his opportunity set was expanding quite rapidly. And he was excited at the opportunities that that was going to bring. So I do think that if you're a well-resourced manager, this could be a very good time to be making changes to your trust and buying some good things. And I think for investors, it's well worth having a fresh look at real estate if you haven't been looking at it for a while, particularly if you are a yield investor, because you can really obtain these nice high yields now and lock them in. And you would imagine that you're building in a bit of resilience into your portfolio at the same time. I think there is an argument at this moment to have a bit of a barbell approach so that you lock in some high yields and some resilience at one end of your portfolio and perhaps start feeding some money into these depressed growth areas at the other end as well, so that you have a nice balance there and you're taking advantage of these big discounts in these different parts of the market. That's pretty much it. I was just going to check and see if there's any more questions. Somebody's asked me if I've added to my own property holdings. Yes, I have, actually. I do eat my own cooking, as the phrase goes. And there is one other particular opportunity as well in the sector that actually I won't give away today because it's in the newsletter, which goes in my newsletter, which goes out this evening. But I do think that real estate is a place to really think about carefully, and I've been putting more of my own money to work in there. All right, that's it from me. I'll hand back to Jayna now to have a chat with Tim. Thank you very much.
Brilliant, thank you, Andrew. Just share my screen again.